Well, whenever we go through a recession, we reset the clock. Back in 2022, we thought it'd be the first year in a decade to see international outperformance of U.S. stocks and the start of a longer-term trend. They did outperform last year, and they're outperforming again this year. The reason for the change in relative performance is the recession. I know an official recession hasn't been declared yet, but we believe a global recession began last year. And over the past 50 years, I do, a mild one. Every time we see this, we see a reversal in the relative performance of U.S. and international stocks. So whatever outperformed the last cycle becomes the laggard. We go from leaders to the laggards. We've been using a shark chart to talk about these cycles in investing and the danger.
Big vision of it, just so people can see. And basically, it's that they go in these long kind of spans. And you think we're in a period when there's going to be a big trend reversal. And the bottom line, here's what I find interesting, Jeff. I would expect you to say, Kelly, a global recession started last year. Here's the shark, by the way. You think that gap's going to close about performance. I thought you were going to say global recession started last year, so European stocks will start to underperform as well. I'm surprised you think that they will continue to outperform, and why is that?
So when we get into these cycles, again, this reverses. It's behavioral as much as it's fundamental. In the 80s and the 2000s, international outperformed. That blue line was rising, and the orange line was rising when the U.S. outperformed in the 90s and the 2010s. And after a full cycle of outperformance, trends revert. Valuations are too high. Earnings expectations are too high in whatever has done well, and that was the U.S. We're now seeing the opposite, right? Earnings are actually doing better internationally than they are in the U.S. This quarter, U.S. S&P 500 earnings down 3%. Year over year for the quarter. In Europe, up 10% year over year. Valuations are very different as well. We're also seeing a lot of other factors like the characteristics that are driving the market. It's no longer liquidity-driven tech stocks that are driving the markets higher. It's higher dividend yields and lower price-to-cash flow ratios that have been driving the markets within and across sectors, and those are more prevalent outside the U.S.
Wow, Seema, I am truly a little surprised by all these developments.
What's doing even better than Europe, Kelly, though, is emerging markets up 10% this year, $13 billion in inflows. And we're only in the first 3 weeks of 2023, surpassing all records that we've seen. And if we really take a step back, the emerging market trade was dead for 10 years, right? It did nothing.
Exactly.
And suddenly you're seeing this sharp turn in sentiment. Part of it has to do with more Wall Street strategists expecting international equities to outperform the U.S., as Jeff was alluding to. But then you have these other drivers like the China reopening and now being emboldened by new numbers that we received from Inside Asian Gaming, which suggests that the Chinese are now visiting Macau more. You're starting to see that activity pick up on the ground. And valuations, too, even when you look at, because emerging markets are so depressed for so many years, even the big spike that we've seen this year, still trading at 12 times earnings, still cheaper than the S&P 500 and the NASDAQ.
Is this like a last hurrah moment, though, Jeff? I mean, I don't typically think about global recessions as a period of time when equities anywhere do well.
Well, it's a transition period, and usually markets tend to bottom before the recession's over. But here's what's important: we're already in a bull market for international investing. European stocks are up over 20%. The bear market's over, I think, for these equities. Not to say volatility can't reemerge, and I would say that China both poses an upside risk to growth, but an upside risk to inflation as well. And should the European Central Bank become much more hawkish than it's expected to be right now, that could be a negative. Alternatively, if the Fed moves to aggressively cutting rates later this year, that could return us to the liquidity-driven environment that powered U.S. tech stocks in the last cycle. So there are tail risks to this, but I think the base case scenario of hike and then hold for the global central banks points to international and emerging market outperformance this year and probably for years to come.